Hey everyone, excited to be back to this week's edition of Frequently Asked Questions for Commercial Real Estate. In today's video, what I want to do is talk about a topic that is extremely pertinent to our industry, and that is how are commercial real estate interest rates calculated? So in today's video, we're going to explain how lenders assess commercial real estate interest rates and ultimately provide you with one for your real estate purchase. And then we'll also dive into the reasoning for it. Now, before I end this video, I'd greatly appreciate it if you can like and subscribe to this channel. It really does help with the YouTube algorithm, ensures more and more people can hear this message and learn about the many facets of commercial real estate. So now I've done that. Go ahead and like and subscribe below. Let's go ahead and dive into this episode. All right. So I actually made a post about this exact topic last week. And the reason why I did was because the Federal Reserve decided to lower their federal funds target rate by 25 basis points. So the current range is between 4 and 4.25. So I saw a lot of people, unfortunately, in our industry post about how this means that interest rates are going to drop. And some were even suggesting that the 25% or 25 basis point drop signified a one-to-one relationship between what commercial real estate interests were going to be in the future. So meaning that commercial real estate interest rates had dropped by 25 basis points, which is completely false. It's completely incorrect. And so I wanted to create a post last week that kind of explained the phenomena, and today I created a video that kind of explains the same thing. So commercial real estate lending rates are not directly tied to the Fed funds rate. Now, the Fed funds rate, when it starts to diminish, indicates that there is weakening in the economy because the Fed's initiative is to modify, to quell inflation. And then as the labor market begins to tighten and or potentially the labor market begins to expand, there's less opportunities for people. Well, that's their other mandate. And so in an environment where the labor market begins to become volatile, they will typically lower interest rates to help stimulate the economy in some capacity. So in that relationship, it typically does lead to some modification, but it's not what lenders use typically to issue the interest rate that you ultimately get when you start having conversations with commercial lenders. Typically, the benchmark that lenders use are either the 5-year treasury, the 10-year treasury, or SOFR. And the reason why they do this typically is because if you're a lender and you have cash and you're looking at different investment opportunities, well, a treasury typically is what's known as a risk-free rate of return. So you could put your money in a 5-year treasury, and that treasury is backed by the strength of the U.S. government. So that in and of itself, in our current environment, we consider pretty risk-free, right? As of right now, the U.S. has not defaulted on their debt, and so therefore your money in that treasury is likely going to be pretty guaranteed. And so if your baseline rate is 4%, then you can expect a 4% return over the course of the 5-year period if you're issuing a 5-year treasury. So commercial real estate is going to be the return on commercial real estate is dependent on a variety of different factors, right? It could be based on location, the credit worthiness of the tenant, the type of asset, also the condition of said asset. And so there's a lot of more nuance to determining whether or not a commercial real estate loan on a property is going to give you a certain level of return. So what ends up happening is that lenders like to have a spread between the risk-free rate and ultimately what they charge you as for a percentage on your loan as far as their return on their investment. So the riskier the opportunity, the higher the spread, meaning that your interest rate is ultimately going to be higher. And if it's a slam dunk deal with a credit tenant and you're, super well qualified to take out a loan, maybe the credit spread between what the risk-free rate is and what ultimately they offer you is much lower. And so there's a lot more nuance to what your commercial real estate interest rate often ends up being. And so the real rate, the real drivers of what commercial real estate interest rate you receive is, number one, where are the 5-year treasuries, 10-year treasuries, or SOFR? What are the market conditions? What are investor demand? Inflation expectations, lender appetite. That's another thing that's also a driver. So, there's some lenders that may not like hotel development, but other lenders may be all about it. Maybe their portfolio is lacking in that environment, in that category, and they're seeking opportunities in that category. So lenders' appetite and their borrower strength can also be a big driver. And then also really the property type and deal structure, right? So in an environment like this we find ourselves in today, in September of 2025, downtown office tends to be struggling. So you can imagine that most lenders are probably going to give you more. There's going to be a larger spread between the risk-free rate and what ultimately they offer you as an interest rate, because it is a riskier investment opportunity. They may require more down payment. They may have a higher interest rate. They may require more collateral, et cetera, because it is a higher risk. Now, you may have another investment that's in maybe industrial has been kind of one of the darlings in recent years, where you have a Fortune 500 company occupying an industrial building. They signed a 20-year lease, and it's almost guaranteed you're going to get paid on your money. Well, in that case, you may get more attractive financing from a lender, especially if you're a well-qualified borrower. So that kind of gives you an understanding of how commercial interest rates are calculated. Again, they can over time shift, especially in an environment where there is more competition. Lenders are starting to compete more with one another to try to seek out these types of opportunities, but it's not directly tied one-to-one to the modification of the Fed funds rate. That is a myth, and I want to make sure that people understand that. So hopefully you gain some value from this video. Hopefully now you understand how commercial real estate interest rates are calculated, so that you can better inform your clients as to how the environment may shift over the next 12 to 18 months. If you guys like this channel, please like and subscribe. It makes a huge impact on our ability to reach a broader audience, and we greatly appreciate the support. Along with that, if you guys are looking to buy, sell, or lease commercial property here in Louisville or its surrounding areas, I'm a commercial broker in town. I'd be happy to help you with your search. You can reach me at 502-536-7315, or you can reach me via email at Raphael@sumcg.com. Thanks again so much for tuning in, and we'll see you all next time.